Everybody knows moving averages, they are very popular, but really very few know about the other kinds of moving averages, like Kaufman Adaptive Moving Average, Hull Adaptive Moving Average, TEMA, DEMA, VWMA, and the list goes on and on. In this video, I'll explain to you what is the moving average, how can you use it in building strategies, and what is the best type of moving average for scalping intraday strategies and for daily swing strategies. Also, as a bonus, as always, I'm going to show you a unique way to use special moving averages in the building blocks of your strategy. So let's start. Hello everyone, my name is Ali Casey and you are watching StatOasis channel, where we discuss finance, investing, algorithmic trading, and everything else in between. The goal of the channel is to arm you with the right education to trade profitably in the financial market. So moving averages are very popular, and let's start with the definition of a moving average. So as the name implies, the moving average is the average of several price points. So for example, if we take a 5-day moving average, for example, let's take this one. So this is 1, 2, 3, 4, 5. We take the close of each bar if we are calculating the close, and we add them all up. So that's 5 points, we divide it by 5, and we get the 5-bar moving average. So then each moving average has 2 points. One is the price point, and the other one is the period that you are calculating the average of. So a 50-bar moving average will calculate the last 50 points. This price point is different. It can be close, open, typical price, which is high, low, close divided by 3. Any point you pick or any indicator you pick, basically you're picking a price point. You're adding all the points up correlated with the period, the look back period, and then you divide it by the number of points, and then you get the average. That's it. So we can see that the green line is the 50-day moving average, while the price is doing up and down movement. So basically what the moving average gave us is a better way to smooth out this noise, because this is at the end noise. Now, moving averages works on all time frames. Intraday, weekly, monthly, whatever you pick, it's going to work. Basically, it smooths out the price period that you pick, and you can pick from 2-day moving average to 1,000-day moving average. So the periods are open, the price point is changeable, so it's very versatile indicator. Now there are different types of moving averages, and they all fall under 3 categories. So there is the simple moving average, which we just show, and then there is the weighted moving average, which basically takes the last data point and gives it a higher weight. And the third category of moving averages are smooth moving averages. And the point of the weighted moving average, like I mentioned, so last points have more weight. So for example, we can see that when the price moved up here, like in this period, we can see it pulled the weighted moving average higher than the simple moving average, because those periods has higher weights, while the simple moving average, it takes a while to get all these points into the average. So for example here, the orange line is the Hull moving average. Basically, Hull moving average is an adaptive moving average, and we can see that it hugs the price closer than the other averages. But in a sideways, we can see it's smooth and moves almost sideways, just like the price. So here we can see that this is the green one. The green line is the simple moving average, and then the blue line is the weighted moving average, and the red line is the volume weighted moving average. And then we have this orange line, which is the double exponential moving average, and this gold line, it's the Hull moving average. Now here I kept 3 moving averages, which is the DEMA and HMA and TEMA. So because the HMA, we can see it is more adaptive, but it overshoots. So we can see this is the golden line, which is the Hull moving average. It's always overshoot on the upside and on the downside. The double moving average is better, and then the triple moving average, the triple exponential moving average, the blue line, we can see it's the best one in hugging the price. So when we have a sideways market, we can see it actually sits in the middle between the two averages, but it is the first one to catch up to the price, up and down. And we can see here, look at the golden line, which is the HMA, overshoots and overshoots here, while the DMA is lagging. If you're waiting for the price to cross, the price crosses here, while the TMA crosses here. So the idea is that triple exponential moving average is very, very sensitive to the price, yet it's very adaptive in sideways market. So we have too many, actually. I mean, this is just the tip of the iceberg. There are so many variations of these moving averages. The best way, I thought, is to illustrate is by building a simple system, and let's see the effect of these indicators. So here I built a system which is the 20-day moving average crosses the 50-day moving average, we will go long. And when the 10-day moving average crosses below 25-day moving average, we will go short. And we are trading crude oil since 2001 and one contract. Now, this is not a system. We are just comparing the moving averages together. And by the way, this is not a not a mistake. So this is 2008, and we can see 1, 2, 3, 4, 5, 6, 7, almost 8, 9 trades that we went from 40 plus to minus 40. In any case, like I mentioned, this is not a trading system. So I built this system on different type of moving averages, but holding the same period. So it's always 20 greater than 50 to go long, 10 below 25 to go short on crude oil. And here are the systems. So this is the exponential moving average. This is the smooth moving average, linear weighted moving average, Hull moving average, Kaufman adaptive moving average, triple exponential moving average, and simple moving average. And if we sort by number of trades, so we can see that the smooth moving average is the lowest number of trades. That means it is the least sensitive moving average. Because remember, we're only waiting for the cross to trade. So that means it's the least amount of crosses we have. And you can see it actually in the average number of bars in the trade. It's also the highest, 61 bars in a trade. And then we have Kaufman at 55 trades. And then we go all the way down, and then here we have the Hull moving average. So the Hull moving average is the most sensitive to the trades, followed by the triple exponential moving average, followed by the linear weight moving average. So this is very valuable information when you're building systems. What this tells us is if we want to trade fast, basically scalping, then you want to trade with Hull moving average or triple exponential moving average or linear weighted moving average. And if you want to trade swing trading or long-term trend following, then we will use the smooth average or Kaufman adaptive moving average or the exponential moving average. In fact, between all these averages, the simple moving average sits right in the middle, which is just strange. So let's look at the linear weighted moving average. While the number of trades sits correctly between those sequentially and the average number of bars also correct, but we can see that the average trade is not sitting proportionally like the others. So we can see the two below are losing money, and then the average trade here is more than the three above. It's like an outlier. This one is 55 trades and this one is 104 trades, and it's making more money. And it's only this one that it's making higher average trade, but at 41 trades. Also, this one is 21 bars in a trade, and this one is double the number of bars in trade, and still it's making a lot less money. So what I deduct from this simple test, I mean, this is not a thorough test by any sense, but it looks like the linear weighted moving average have a higher quality signal. And of course, because it's the highest average trade and still relatively the highest number of trades, So obviously it's the one that's making most money. So the takeaway from this testing inside StrategyQuant X through the ones available to us anyway is Hull moving average and triple exponential moving average are the most sensitive to trade, and therefore you can use it for scalping for fast strategies. And the least sensitive to trading are the smooth moving average and the Kaufman adaptive moving average. So these are meant probably for swing trading, long-term trend following. Also, it looks like that the linear weighted moving average have the best quality signal. Now for the bonus, I will show you a unique way on how to use moving average in a trading system. So this is a unique strategy. This is called a rainbow moving average. Now there are again many variations of this. I'm just showing you the concept and then you can use it as you like. So the concept is to draw many moving averages, and then there are several ways to determine how to trade with it. So for example, here we have 10 moving averages, and this is the 200, and this is ranges between 20 and 60. So first strategy can be when the moving averages are above the 200, and when 3 rainbow above the rest, then you go long. And when they flip down, for example here, and when when all of them below the 200-day moving average, and when the fastest 3 are below the 9, then we go short. Another strategy is when the price is above 7 of the 10 moving averages, we go long. And when the price is below 7 of the moving averages, we go short. And when the price is in between, we don't do anything. Now, of course, like I mentioned, there are many variations of this. So here we are using, for example, this is the EMA, and of course you can use RMA, and we can use WMA, and we can use VWMA. We can go back to simple moving average. And then of course you can go crazy. And here I have rainbow of 60 moving averages. And again, you can pick any number. You can say if the price is in the top 15% of the moving averages, we go long, and on the opposite we go short, and in the middle we don't do anything. And here the colors are of course giving us a visual reference, so we can see, for example, regardless of where we are, when we hit the red zone, then we can exit the strategy, and when we are below the violet, we go short. When we are above the blue, we go long. And you can see there are many ways to interpret this, but it's really a unique way to use a moving average. Basically, you are using an ensemble signal. So this method is used heavily in some hedge funds, where they either use ensemble of trading systems, like for example, you build 10 intraday trading system on the ES, and if 6 of them say go long, then you go long. And same thing on the opposite side. But here we are using an ensemble of moving averages, and then we can say if the price is above, again, 70% of them, then we go long. If it's below 70% of them, we go short. And anything in between, then we consider that the market is in sideways and we don't take any trade. So I hope this opened your eyes to more ways to use moving averages other than above 200 is long and below 200 is short. And of course, if you have any questions, any comments, I will be very happy to engage with you in the comments down below. Of course, you can take it further by joining the Discord server through the Patreon link down below. And as always, good luck with your trading, good luck with your investing, stay safe, and I'll see you soon.